Hello and welcome. My name's Andy Crook, and my mission is to help garage owners become more successful in business. And I'm your host for tonight's training on the subject of profit first. I'm in a bit of IT drama here. Every week I deliver free business training to help garage owners become more successful in business, sharing with you the exact same methods I use to turn a 75k loss in my garage business into a modest profit in a little under 2 years. It's all based on the principle of incremental gains and continuous improvement. The Atomic Success Program can produce massive results. So I'm really excited tonight to be talking to you about profit first. Profit first is one of the things that I've implemented in both my business and my personal life with some great effect to achieve things that I never thought was possible. So the subject tonight is all about profit first, and what we're going to talk about, we're going to talk about the profit first program, and then we're going to talk a bit about something called Parkinson's law, which is what makes profit first work, and then we're going to look at your target allocation percentages. And give you some ideas of what they could be depending on the current turnover of your business. So they're the three main topics. So if you remember from last week, 3 is a magic number. There's always three elements to a training topic when I deliver one. So they're the three things. So let's go on with it. Profit first. Profit first, tonight's training topic, is based on a book by Mike Michalowicz. Now, if you've read any of Mike's business books, you'll probably agree with me that they're very, very easy to read. He makes the subjects that could be a little bit dry interesting, because he always has a bit of a story going on. He always uses examples, and he takes what appears to be common sense concepts and turns them into something that we can all use and implement in our business. So he's got a number of books out there. The two that I like most, the two that I kind of latched onto when I did my research into improving my business, were Profit First and Clockwork. They were the two that I really liked. I've read many of his others, such as the Pumpkin Plan and the Toilet Paper Entrepreneur, stuff like that. They're all good, but I don't think they're as good as Clockwork and Profit First. Now, Profit First is simply a bank balance accounting method. So Profit First is a bank balance accounting method. And when I'm speaking to small business owners, whether they be garage owners or not, it doesn't really matter. And I speak to them about bank balance accounting methods, and they've never heard of it. But basically, it means you run your business basically by what's left in the bank on any particular day. So decisions are being driven basically by your bank balance rather than by yourself and any sort of sound financial planning. So this is if you like, an improvement on that basic method of checking your bank to see if you can afford to do what it is you would like to do today, pay for something, pay your suppliers, etc., or do you need to work a bit harder? This is an improvement on that method by still using a quick and simple reference. Some people I speak to swear by just looking at their bank balance once they've implemented Profit First as a method of knowing or seeing the state of financial health of their business. Obviously, it's just a quick method of checking your financial health. You still need to meet up with your accountant. You still need to have forecasts. You still need to do all the other good stuff that you need to do around your business planning, especially around your financial planning. But it does give you the ability to look at a single bank account and go, you know what, we're doing okay. Or, whoops, we're struggling. So Profit First is simply a bank balance accounting method. That's all it is. Now, it's also based on, or it's very similar to a concept that was around a few years ago that probably didn't have such a sexy name, which was called Pay Yourself First. And one of the things that Mike Michalowicz, the writer of Profit First, is his mission, where mine is to help garage owners become more successful in business. Mike's mission is to eradicate entrepreneurial poverty. So his big thing in this book is making sure that the business owner gets paid. So you take your wages out of the money first, and we'll get to the how you do that in a second. So, and it's kind of that older concept which was called pay yourself first that Mike's taken and sort of added his own spices, if you like, and jazzed up the dish. So what is it all right? What is the profit first program really about? Well, the commonly accepted accounting method for calculating profit is you take your sales, you take away your expenses, and what's left is your profit. And that is how profit is defined in just about everybody. What what in profit first we do is we look at our sales, so we have the same income, but we take the profit first, and what's left is the expenses. So mathematically and algebraically, that is exactly the same outcome. That formula is balanced. So sales minus expenses equals profit. Algebraically is exactly the same thing as sales minus profit equals expenses. They are both the same. However, they're not, because of something called Parkinson's law. And Parkinson's law basically means that the work will expand to fill the time available to do it. Or you will use all of the resources available to you. So an example, and one that Mike uses in the book, is of toothpaste. So if you get a new tube of toothpaste and you open it and you put your toothpaste on your toothbrush, what you'll do is you'll be quite generous with your toothpaste. And if a bit falls off as you're putting it under the water before you rinse it off before you put it in your mouth, I've no idea why we do that. Why do we wash the toothpaste? It's come out of a sterile container, but we wash it before we put it in our mouth. We always do, and we always will. However, we'll put a nice big fat piece on. And if a bit falls off while we're, oh, never mind, we'll put a bit more on. There's plenty where that came from. We've just opened a new tube. Now, that same tube of toothpaste, no different. When it's coming to the end, if you're anything like me, you're now twisting the tube so you can get all the way to the bottom and squeezing the last morsel out before you brush your teeth. Because it becomes a more scarce resource as it becomes less and less, and therefore we treat it differently. And that is the same thing as the Profit First program. That's what it's saying is, if you take your profit first, what you're left with is your expenses. And that is how it uses Parkinson's law. You will get by with what you've got left. You will use all of the resources available to you. So if at the beginning of the month you do not separate your profit, you will end up with no profit because you will use all of the resource, in this case money, available to you to get through the month. If you take some of that money away at the beginning and you pretend it never existed, you will still use all of the resource left, but you will have some tucked away somewhere else, your profit. And that is basically the profit first principle. That's basically all it is. It's about discipline. That's what it's really about. Having a financial discipline and working out how much you can allocate to the different accounts. So in the profit first accounting method that's in the book, what you're encouraged to do is to open 2 additional bank accounts. So your existing account is your income account, where money comes in as you do work, people pay you, comes into your income account. And then you have another new account, and that is the owner's pay account. And you put a proportion of the money that comes in into that account. And then you also have another account, which is your expenses account. And the idea being is the suggestion is in the book that at least once a week, if not twice a week, what you do is you take all the money that's come into the account and you split off, you allocate part of it to the owner's pay and a bit of it to the expenses. And you carry on. And at the end of the month, you pay yourself, the business owner or owners get paid. And that is the pay yourself first element, if you like. And then what you use the expenses account for is you pay all the expenses. The cost of doing the business comes out of there. Whatever's left in the income account, your original checking account, if you like, is then split into a savings account. And what Mike asks you to do as you get slightly more skilled and more disciplined with this is you then split your savings account between your profit and your taxes. And you allocate an amount to your profit, an amount to your taxes, and then every quarter you pay your VAT bill and you pay your taxes, and you then, whatever's left over, you have as dividends or as extra profit. And that's how the system works. So you can see that it requires a fair bit of discipline. So when I looked at this, I thought, ooh, this is a bit difficult. This isn't that easy to do. I decided to simplify the system and just have the owner's pay account as a separate account. Now, if you think about this for your personal bank account as well, is we've probably all got a savings account with nothing in it. And a savings account that we started off, we're always going to put some money away, and then life gets in the way. We take the money out of the savings account, and we never actually put it back in, and that savings account gets dwindled away or forgotten about. Well, what I did was I got a savings account that I can't take money out of very easily, and I every month when I get paid, I put a amount in my savings account, and I decided I was going to save for something, and that meant I had to tell the bank that to withdraw money, I had to go in and withdraw it, whereas I could transfer the money electronically. I had to physically go in with a book to withdraw it. Now that account, and sadly, is closed down. Banks don't want you to do that. The money is too easy to get to. So I transfer the money into a different account that isn't with the same bank. So I have to sort of make an effort to go and look for it. And I don't have online banking for that account. I have a card, and that's it. But that's where the money goes. And that's what stops me from taking that money away. And what the profit first accounting method asks you to do is to do something similar with your savings account. So your income, your expenses, and the owner's pay account is you can transfer money back and forth readily because you need to do that at least once a week. But at the end of the month, then you transfer the money into what's left in the income account into your savings account, which is an account that you can't readily take money out of because it's for your taxes and your profit. And what you do with your profit at the end of the quarter or the year, depending on how you look at it, depends on you whether you're going to reinvest that in the business or you're going to take it as dividends. That's totally up to you. Depends. Well, but this way, at least when your accountant tells you you've made a profit in the year, that the money exists. It's actually there because you took that money and you put it somewhere else. And that's the whole idea behind the system. So my simple system is, instead of having multiple accounts, is you just have one savings account and you call it your owner's pay or your profit account, whatever it is, and the percentage that you allocate to your pay or to your profit, whichever one you want to prioritize. For me, when we started doing this, we use it as our VAT account, and we put a percentage, it's 5% for us, of all income that comes into the business into the VAT account. And then every quarter when the VAT bill came, suddenly we had the money to pay it. We weren't scratching around looking for it. It just, the VAT covers itself and a little bit more. So that's how we started it off, very, very simply. So if you want to make sure you get paid, and remember, many, many business owners out there do not get paid. Yeah, put that money into a separate account, just one account, and then whatever's left, that will do for the business. That will take care of all the business expenses. That will take care of everything else. But at least you're getting paid every month. And that's a great way to start. And then you can build up and build up and build up and use the full profit first accounting method if you want. But how much do you allocate to each of the areas? So in the book, Mike sort of gives a rough rule of thumb, if you like, for how much you should be allocating to the different areas within your profit first allocation percentages, what he calls target allocation percentages, or TAP, target allocation percentages. So what Mike said in the book is, if your business turns over up to £250,000 or dollars a year, you should allocate 15% of all money in. So the income into the business, 15% into your taxes, 50% into your owner's pay, 5% into your profit, and 30% for expenses. So up to 250,000, 15% tax, 50% owner's pay, 5% profit, and 30% on expenses. If your business turns over somewhere between 250 and 500,000, tax is once again 15%. Owner's pay is now 35%. Profit is 10%, and expenses is 40% of that income. So 250 to 500k, tax 15%, owner's pay 35%, profit 10%, and expenses 40%. If you're turning over somewhere between 500,000 and £1 million, that's your revenue in a year, taxes are once again 15%. Owner's pay is now 20%, profit is now 15%, and expenses is 50%. So tax 15, owner's pay 20, profit 15, expenses 50. And that's how he suggests that you should target your allocation percentages. And that's what you're looking for. Remember, if you're starting this brand new, you've never done it, jumping in and spreading money around like this is probably not going to work. You're going to probably have to start slowly and build up to it. So the simple system which I started with was just one different account, one savings account, and I put 5% of all the income in. And I did it every time we had an invoice. I put a 5%. Don't have to be that mad. Once a week, add up how much income is, put 5% of it into the savings account, and away you go. And then over a period of time, as you start to get better and better, remember, you build this into your financial planning, into your 1-year plan. You want, let's say you're aiming for, say you turn over somewhere between 250 and 500,000, and you want to have a 10% profit, then you're going to work up to that. You're not just going to start putting 10% by, especially if you're not seeing that profit at the moment. You need to build up to it. So that is the profit first principle. It's a great book. Highly recommend you read it. It's entertaining as well as informative, and it's well worth giving a go. So if this training or any of the other videos I've made make you think about how you're running your business, then I've achieved my aim. If you think you need more help and support to implement any of these changes and improve your business, simply send me a message. Just DM me on Facebook, and then what we'll do is we'll jump on a Zoom call and I can see if we can help your business. Remember to put first things first, and if you think you should, you must. Thanks for listening.